We help married professionals gain financial stability, build generational wealth, plan their retirement through life insurance, trust, and personalized financial strategies. Today I have with me an amazing person, Miss Rose Apollon. Miss Rose, please take a minute, introduce yourself, and tell the people what you have for them today.
Thank you so much for having me, Wilkin. First and foremost, this is a wonderful opportunity, and for even being able to have the opportunity to be with the It's Possible podcast. Well, it is truly by the grace. My name is Rose Apollon. I am the president of Liberation of Self. With Liberation of Self, where we're here to actually educate others, for them to actually get the knowledge and the understanding. So that way, rather than them hoping that they could reach retirement, we actually do it with strategic planning. So what I do, I'm a financial educator, and by the grace, also one of your partners, where we actually combat the darkness of not having enough knowledge about our finances.
Excellent. All right, so you say liberation of self. What does that really mean?
Liberation of self, it means a lot. I truly do believe that with love, it comes with liberation. So you can't actually be constrained, but then turn around with us with the information that I actually pass on to my clients, to my colleagues. They're actually able to stop living and actually start being. So with it actually gives them the tools. It actually gives them the knowledge to where they'll be able to understand and how to start strategically planning everything.
All right. So based on what you just said, okay, liberation of self, you help people to liberate themselves.
Correct.
Liberate themselves from what?
From lack of knowledge.
Lack of knowledge.
Lack of knowledge. Because I always say where you want to be and where you're wanting to go, it's lack of knowledge that's stopping you from getting there. And a lot of people in the United States, and I used to be one of them, where I'm just following the masses. Everybody's doing one thing, and hey, I'm going to follow exactly what they're doing.
But okay, just a moment. You say lack of knowledge.
Correct.
Knowledge of what?
Knowledge of how, like the rule of 72, knowing how to actually create a financial foundation.
Okay.
Knowing the rule of the 4%. Because a lot of people say, hey, I want to retire, but then turn around, they don't know the rules. So with us, due to the fact that we're literally following the masses, we're not being educated to know that there are other options. We're not being educated to know that, hey, if I put myself or if I put my family first, rather than putting money in the bank and getting only 0.01%, I could actually get compounding interest. I could actually get the safety. I could actually get living benefits. I could also be able to be my own bank. So there's so many things that people just don't know about that are available to them.
Okay, so knowledge. So we're talking about money here, right?
Yes.
We're talking about money. Just say money, right? Because all right, people want to know what we're talking about.
We're talking about money. We're talking about money.
You've been working hard as a professional, but you say to yourself, man, if something happens in my family, I don't think we have enough money. That's where we come in. That's where It's Possible insurance and financial services comes in. We have families like yours plan their future. We use life insurance, annuities, and estate planning. Now, when you do business with us, you become the hero in your family. You are the one who breaks generational stress in your family. When future generations are talking, they will be talking about you because you are the one who made the decisions to give us a call. You also help us bring guests like this to come on the show to give you information that can transform your life. There is a Zoom link. Just go ahead and click on the link, book a call with me so that we can go over your finances, how it can help you plan the future and build wealth for your family. Thank you very much. Let's go back to the video. That's cool. So the problem is most people don't know about money, right? Because you know that if you want to make money, you go to work, get a job, work 16 hours a day, and I mean, you save your money. That's how you make money. That's what I think.
That's actually the old ways. What ended up happening is a person has to think about it. If you're working 16 hours a day, right?
Yeah.
Let's say, God forbid, the person end up having a stroke. Are they still able to still perform where they going to work for 16 hours a day?
No, they can't.
Okay. So now, let's say, God forbid, the person mortgage or the person's light bill or paying for, medications. Will those responsibilities go away?
Well, bill's still coming.
They are not going to forget that person's address regardless of whatever is going on. So with us, it makes sense to actually plan things out the right way to where if God forbid the person is not able to go to work, let's make my money work harder for me than I work for the money.
This is powerful, right? You make money work for you instead of you working for the money. But what I believe before people get to that point, there are certain trauma they have in their mind that would stop them to hit that level, right? Because trauma of showing off. Because sometimes we've been so low that when we finally get some money, we got to tell the world that some money just came in. And the way we do that is by buying the expensive things. And right. So what can you say about that?
And it's sad because we're living in a world where people feel like having the latest phone or having the latest car is actually showing value. But then realistically, if a person think about it, let's say I just decided to go buy like a nice Rolls Royce, right? $350,000, just drop it, right? But then turn around, once I pull out the lot, the car value is going to go down. But then while the car value is going down, purchasing the car is not giving me any gratification versus if I took that same amount of money, park it into myself and allow it to grow with compounding interest.
Okay.
Where every 10 years, I could actually get access to over $1 million without even having to pay taxes on it.
That's good. I mean, I understand what you just said, but about the car, if someone is going to buy a $350,000 car, it's because they have the money. I don't think someone will only have $350,000 and take it and buy a car with it. Right. So, I mean, it's not bad to buy your $350,000 car if you have a couple $1 million. And that's fine. But one thing I want to come back to you with, where you say that you put that money in self. What does that mean?
When you put the money into self, it's basically stating that, let's say, for example, I took $10,000 a month and I saved it for my retirement, right? Well, after 10 years, that's only $1.2 million that I would have invested into myself. But then turn around for the rest of my life, I will have access to over $1 million tax-free.
Now, when you say invested in yourself, now in your pocket, how do you invest that money in me? Like, how do I put it inside of do I put it in the cup and drink it?
So when you invested in you, it's basically what you're doing. You're parking the money into an IUL.
Okay.
A lot of people, the people that says bad things about IULs, it's only because of the fact that they have not been educated through the art of IULs. IULs are one of the most powerful tools that a person can actually use to actually save money on taxes, get money free of taxes, build wealth within it, but then in the same time beat inflation and taxations in the same time.
Okay.
So with me, due to the fact that I've been within the realm for over a decade, I've been able to play with numbers. I've been able to take numbers, multiply it, borrow against the money, and then still allow the money to keep on growing.
Let's talk about this. Like you borrow against the money. I remember you said that you were able to renovate your home with money that you took from a life insurance policy.
Yes.
So when we talk about IUL, we're talking about life insurance policy.
Yes.
Okay. So
Yes.
tell me how you do that.
So when I take my money, I actually park it into myself or my family. So the reason why I do that is because I get compounding interest. And with my compound interest, because of the fact that it's an IUL, I'm not limited when it comes down to my interest. So back in December of 2022, whole life policies were regulated to where they cannot surpass 6% interest. Well, we know right now inflation surpassed 6%, right? But then turn around, what I'm able to do, I'm able to I overfund my policies. When I overfund my policies, I'm then able to tell the company like, hey, leave my money in there as collateral, but let me borrow against my money. Mm-hmm. So when I do that, what ends up happening is my money is still receiving the compounding interest of the growth, but then turn around, I get the capital of the company for me to go spend to do whatever I want to spend.
All right. So what's the benefit now to overfund your policy if you already had the money in the first place? Why would you take your own money and drop it into a life insurance policy and come back take a loan against it? Because you already had the money, correct, and then you drop it into a policy and you take a loan to use. I don't get it. So why would you do something like that?
That's such a beautiful question.
Yeah.
So let's say, for example, I have $50,000 and it's sitting in the bank. Mm-hmm. If I go inside the bank and say, hey, let me get $45,000, that's me I'm withdrawing $45,000 out of my own money.
Well, you can use your money in the bank as collateral to take a loan.
But then with my policy, my money in my policy, I get compounding interest.
Okay.
Versus if I go do it like in a CD, it's probably simple interest, and it's under the inflation rate.
Okay.
So anywhere where I'm actually getting money less than inflation, I'm losing money. But then the worst part about it is if it's a CD gain, I will actually have to pay tax on that capital gain.
Oh, okay.
So I will have to pay taxes on my capital gain versus if I do it inside of my policy, I don't have to do that.
Got it. That's pretty good. Yeah, because my thing is if you already have $50,000, you still need that money. You put it inside a policy. So you come back, you take a loan against the cash value. You could have done it in the bank. Now, when you take the money out of the policy, or the growth of the money, you can take it out without paying taxes on it. Is that what you're saying?
Two things. When I borrow against my policy, I'm not withdrawing my money. So that's one. And so that means that the compounding interest that I'm going to be receiving, I will be receiving it on $50,000 versus if I took out $45,000.
Okay.
So that's one. And then second, because of the fact that I'm getting compounding interest on the $50,000, then that means that the $50,000 will keep on growing for me.
Okay.
And due to the fact that I borrowed against my policy, then that money that I borrowed, I don't even have to return it back because of the fact that when I passed away, they'll just deduct it from my cash value.
Okay, so before we go that far, let's talk specifically how you use that money to renovate your home.
So two things. Well, my money is still growing. So with me having $45,000 to renovate the house, it didn't really cost me nothing. That's one. So then second, the money that I took out to renovate my house, it's not a money that I'm actually without. Because I'm still getting the compounding interest. I still had the capital to fix my home, to renovate the house. But then at the same time, I don't have to worry about returning that $45,000 back.
Cool. That's beautiful. So for someone who's watching here, it's so you have a life insurance policy.
Yes.
It is an indexed universal life.
Yes, sir.
You put money into the policy, and then you wanted to renovate your home. Then you go to the insurance company, you ask them to give you a loan against the cash value you have inside the policy.
Correct.
With that money, you renovated your house.
Correct.
Okay. That's good.
Well, the best part about it is when I put the money inside of it, I'm actually making my company own the policy. So it's actually saving me money on taxes. But then in the same time, once I get the money out and the money when it's growing, I don't have to pay taxes. So there's so many things out there that people just don't know of. And once we sit down with a family and we're able to show them, okay, this is how you could actually get to where you wanting to go. Because too many people are just working. And God forbid they end up having a heart attack. God forbid they end up having a stroke. God forbid they end up having cancer. Their life, their responsibility is not going to stop.
Cool. All right. Yes. We will come back to this, but there is one thing. Let's go back to life insurance in itself.
Okay.
Because when we talk about life insurance, most of the time people are thinking about dying. They think, okay, they're planning their death. And most people, they say, okay, I got to have life insurance in case I die. People have money to do whatever they want. So talk to me a little bit more about life insurance. What does it entail?
Well, realistically, life insurance is the transfer of wealth.
Okay.
That's first of all. And unfortunately, a lot of people have the wrong misunderstanding of what life insurance is. So within life insurance, a person could actually create their own bank.
Okay.
So rather than being able, like, for example, for my daughters, I'm able to save money for their college. I'm able to save money for their first home. I'm able to make sure that everything that I did not get as a child, that they'll be able to get it. So not only are my daughters grandfathered into life insurance, so they have the protection for the rest of their life, but then within the policy, I'm building them wealth. The reason being is because not only they're getting compounding interest, but then turn around all the growth within the policy, they don't have to pay taxes.
This is good, but I would like you to go a little deeper into life insurance. Like, what type of life insurance are out there?
So there's final expense. The first one is a final expense. Everybody needs to have a final expense. The final expense is there just to basically do your funeral. If God forbid the person end up passing away, their family will receive the money within 24 to 48 hours to do their funeral. But then turn around, there are the renting of wealth. And with the renting of wealth, those are like more like a term policy. With the term policy, it's cheaper, but then turn around, the person is getting the term policy with the living benefits. So that means that if God forbid, while the person is renting the policy, they end up having a heart attack, they end up having a stroke, or they end up having cancer, while they are alive, they'll be able to actually get access to the policy. So if they had $1 million policy, they could actually get access to the $1 million without having to die. But then turn around, the third one is like an IUL. Within the IUL, there's four main important factors that everybody needs to make sure they able to answer. If we end up living too long, we want our money to keep on growing for us to where we will never run out of money. But then in the same time, if God forbid we end up dying too soon, we need to also make sure that we're protected.
Is there such thing of living too long?
Oh, yes. Yes. If a person end up being like 100 years old or 105 years old, you don't want to be a burden to your family. You don't want to be a burden to your kids. So it will make sense that you're able to afford a private nurse. It will be like good to be able to get access to capital to where if you want to live in a really nice nursing home, your money's able to do that versus being a burden to your kids.
Gotcha. So we have the final expense term policy, and then the IUL, Indexed Universal Life. So okay, what about the term that has the return of premium? If the person doesn't pass away in a certain period of time, they return all of the money they paid into the policy.
But with that one, you don't get no compounding interest. It's like literally you taking your money and you're putting it under the mattress.
Okay.
So if your money is not getting interest, which with compounding interest, it means that my money is growing, but while my money is growing, my money's babies are also growing for me.
All right.
Right? So if I put $50,000 into a policy and they refund me back the $50,000, what did I win?
Well,
nothing.
Yeah.
Nothing. Versus I could have saved that same amount of money and then get compounding interest with that. And then after 18 years, that money will be double.
That's true.
Double.
That's true. All right. So now that we understand the different type of policies, let's talk about being your own bank. What really does that mean?
Being your own bank, it gives you so much access. The first part is you don't have to return that money back. So that's me not having to pay that money back. That's my favorite.
Wait. Before you say that, how do you build that bank in the first place? Do you need to have some type of business space where you build a bank or whatever? How do you build this bank?
By purchasing a policy.
Okay.
So once I purchase a policy, I'm like, okay, what is the maximum amount of money that I could put into this policy without having to pay taxes on it? Because that's a big factor.
Okay.
So if a person, for example, let's say they say, okay, I'm getting a $250,000 policy. Well, there's a limit of money that I need to put inside of that policy.
Okay.
Once I put that money inside the policy, then that means that the policy will be paid off. But then in the same time, I'm able to borrow against that money. So when I borrow against the money, it gives me access to my capital, but then turn around, my real money is still growing for me. But then another factor that I love about it is the safety. Because I know that once I put the $50,000 inside the policy, or when I put the $5,000, or when I put the $10,000, I don't have to worry about losing a dollar out of it. But then in the same time, if God forbid, while I am alive, because we are living in a country where we're more likely to get sick before we pass. If I have a heart attack, if I have a stroke, if I have cancer, while I'm alive, I'm able to get access to the death benefits versus my limit of cash that I had in the first place. But then in the same time, all the money that's growing is tax-free.
Okay.
Getting access to the capital is tax-free.
How do you get access to that money tax-free?
By doing a loan against the policy. So if I decided to withdraw the funds, I wouldn't have to pay taxes on it. But then it wouldn't be, I would not receive the same amount of interest because I deducted the funds. But then in the same time, if I borrow against it, it's going to be a loan. But then the best thing about the loan is that it end up being a wash. Why? Because the compounding interest that I'm receiving surpass the fees that they charging me for the loan.
Okay, that's good. So if you withdraw the money from the policy, it doesn't consider as an income?
No.
Okay. I thought it was considered as an income. You would need to pay income tax on that.
No.
Okay.
Not at all. I had a client of mine. I constructed his policy for, I think we're putting like $10,000 a month inside the policy. After 10 years, he would have invested $1.2 million inside of the policy. But then for the rest of his life, every month he's going to get $150,000 tax free.
Wow.
$150,000 tax free
Every year.
every year for the rest of his life. I think altogether, when we did the math, his income he would receive $3.5 million with a fee of cash, but then turn around, his policies will still be worth over $10 million when he passed away.
Wow. I don't think enough people know about what you're talking about here, because people would say life insurance is just in case someone passes away, they have money, but no one ever thought that they could use money that's inside of the policy as they are alive. Yeah, that's pretty good. Now, what's the benefit of being your own bank?
The benefit, first of all, there's no application. Like, so for example, if I put the $50,000 inside of my policy, if I want to borrow $45,000 out of it, they can't tell me, no, your credit is not good to get the money.
Okay.
Because of the fact that it's my money. But then in the same time, having infinite banking within my policy is a great aspect. Why? Because my money will keep on growing for me, surpassing the rate of me using the money. So with infinite banking, it literally gives me access to where, like, the money will keep on growing so much that if I want to pull out $100,000, if I want to pull out $200,000, it'll be there. The capital will still be there.
But that's something that's for people with money, right? It's not for everybody, because you need to have the money. Because somebody was like, they just put $200,000 into an IUL, and they're asking, can I, take a loan of $100,000 now? Because they think that by just having the policy, they have a bank where they can just go ahead and take money out.
Okay, so with it, however you flip it, you're gonna win, right? But then at the same time, it makes more sense to allow the policy to grow. The longer you allow it to grow, the more money, the more capital you'll have access to.
Yeah.
But then if I'm able to drop $200,000, once I put the money in there, the capital is there.
I'm saying $200.
200.
Yes.
So hold on, wait.
Like, okay, some people will tell you, okay, since I have my own bank, they open their own bank with $200. Now they believe that now they have a bank, they can just go ahead and be taking money out of the bank because they just opened the bank with $200.
Okay, now I got it. Okay. So first of all, if you have literally $200, right? I tell people, let's make it seem like we're going to Wells Fargo. If you put $200 inside of Wells Fargo, let's say you stop at Walmart to do grocery, your $200 is gone.
Yeah.
By the time you walk out of Walmart, you'll be gone. But then if I put $200 inside of my policy, right? Now I am growing some cash value inside of the policy. But then in the same time, there's a cost for the insurance. But the best part about it is, if God forbid, after I pay the $200 for my life policy, let's say I bought a policy and it was $150,000. Let's say, God forbid, I got into a car accident and I did not make it home. My family will get $150,000. Okay?
Yeah.
But then if you put your $200 inside of the bank, your family would literally end up having to do a GoFundMe to do your funeral. Why?
Because they only have $200. Yes, I understand that.
Correct.
So, but what I want to hit is that some people that have the misconception of, once they put some money inside of the IUL, the Index Universal Life, they have their own bank. Now it's time for them to get a $100,000 loan because they have a bank. Right. So so some people, this is what they believe. They think that by just, right, it's not $200. It can be $500 because they open the bank with $500, since the bank always has money, they can just go ahead and take $200,000 loan from that bank.
Oh, we're in a world like this. Like if you open a bank account with $500, you can't go, to Walmart and start shopping for $1,000. Why?
No
Because
way.
your bank, you literally only put in $500. So with the IUL, there's cost for the insurance. So because there's a cost for the insurance, the way I construct my clients' policies, I make sure that their money is growing more for them than the cost of the insurance. So I construct the policy to where if you're giving me $200 a month, I will not take all your $200 and drop it into the policy. Mm-hmm. I will make sure that there's a gap between the cost of the insurance and the cost of you saving money.
Yes. But to close that part is that there is no way you can just drop $500 into a policy and get $100,000 from it.
No.
Right? Because that's what I was saying. IUL is not for everyone.
Correct.
Right? So it's not that just you can save $50 a month and then you're just going to have an IUL to build your own bank. So it's for people who have the money and need a place they can put this money, so it's a safe place and the money will grow, but they can just come back and take a loan against the cash value so that their money can be working twice.
Correct.
Right?
Correct.
That's where I wanted to get.
Oh, yes. That one, if a person for any apparent reason think like that, they need to fix, no, let's make it make sense. Like, for example, there are some college plans that are out there that would tell a person, okay, let's save $5 a month and your kids will have, $1 million by the time they turn 18. But then I always ask the person, let's be realistic. If you're saving $5 a month, that's only $60 a year. Where in the world, what kind of interest would you be receiving for that money to actually grow realistically?
Yeah.
So with me, the first thing I do, I sit down, I calculate the numbers because I have to know exactly where my client is, where they want to go, and how I can make the numbers make sense for them.
Okay.
But then, no.
That's pretty good. That's pretty good. So, this is really good. So life insurance is a tool that people can use to do many things.
Yes.
That they didn't even know about.
You could protect yourself. Think about it. Let's say you just bought a phone for $1,000, right? You're going to feel so attached to that phone that, hey, I want to protect this phone. So the first thing you're going to do, you're going to put insurance on the phone.
Yeah.
Right? You're going to be like, hey, T-Mobile, hey, Verizon, if God forbid anything happens to this phone, replace it. Right?
Yeah.
Well, we could do the same thing with us. We could literally protect ourselves. We could literally protect our family to where if God forbid anything happens to us, rather than allowing our family to be like, okay, mom used to pay the light bill, well, she's gone now. No, my responsibility to my family will still hold on even if I'm not here.
Okay.
Making sure that my husband and I are able to pay for our kids' college. Making sure that, we're able to afford their weddings. That's still my responsibility, whether or not, if I'm here or not. So it makes sense that the same way I would protect my phone, the same way I would protect my car, the same way I would protect my home, I protect myself. I protect my family.
That's good. That's good. And sometimes people die. They get some illness. They die just because they don't have enough money to protect themselves.
Yes.
Yeah.
Because it's sad, because let's say, God forbid, the person end up having a stroke. Their responsibilities are not going to go away.
Yeah.
But then turn around, let's say they're like, oh my gosh, how am I going to pay for the light bill? Oh my gosh, I got to pay for chemo. How am I going to pay for chemo? One of my favorite things to do is like clients that had cancer, or clients that's a single mother, but needs the protection. It's really great when we're able to protect them, to where if God forbid something end up happening to them while they are alive, they end up not being a burden to their family. Because stroke is not a joke, but then turn around, the person's responsibility still remains.
Yeah. Yeah. That's good. So what are some other things that people can have in place to protect their wealth?
One of the biggest things that I'm noticing that within our community we're missing is trust.
Okay.
We don't have will and trust in place. We don't have any final expenses in place. So that means if God forbid I passed away, rather than my family calling, hey, can you give me 500 to do her funeral? I should have that thing in place. I should have security for that time. But then turn around, we need annuities. A lot of time people say, hey, I want to retire at 65, right? But then turn around, okay, how much money do you need? How much money do you need to come? Do you want it come pre-tax? Do you want it come post-tax? We're not asking enough questions.
Okay.
So because of the fact that everybody feel like, okay, I'm going to run and do a 401k because everybody's are doing 401ks. But then what else are there? Because with the 401k is going up and it's going down. It goes up one day, down one day. So then turn around. When would you ever reach enough money to where you could say, okay, I could retire?
Yeah. I mean, I don't think people even think about retirement.
So at the age of 15, we could start working. And let's say, for example, I want to retire at 65. So that means that I've worked for 50 years. And the worst part about it is that at 65, the things that I could do at 35 comparing to 65 is not the same.
Yeah.
So by the 9 out of 10, by the time people hit 65, they got a new hip. They got, their ankles are halfway gone. So realistically, once they hit 65, they don't have enough energy within their body to where they could actually do much.
Yeah.
So during that time, they need to make sure that they have money coming in tax-free.
So they need to start planning from at a young age then.
Yes. The earlier, the better. The reason being is because if you wait till you're 50 to say, okay, I'm going to start saving for my retirement, then you're going to have to save a whole lot of money. And that's another thing. People don't even know how much money they need to retire. So,
wow. And I go to places like some stores out there, I see 80-year-old people working. Right? 70, 75, 80-year-old people working. I think they just don't want to stay home. They want to do something.
Yeah, but in the same time, if you think about it, inflation right now is eating up the value of our money. So let's say, for example, that same 80-year-old, she's only receiving $1,800 a month. That's not going to be enough.
So that means their bills are bigger than the income they receive.
Correct.
So they got to go back to work.
Unfortunately, due to lack of planning, they're not able to reach retirement and be like, okay, I wanted to get 5,000 or I wanted to get 6,000. It's really bad because they just living day by day, but then turn around, they don't know the real numbers. We don't know the rules to money. That's one. And anytime you're playing a game and you don't understand the rules,
Okay.
you're
Yeah,
lost
you
before
lose.
you're losing before you even
You
started.
don't even know if you're playing the game. So talking about the rule of 72. Yes. Well, what is it? How does it work?
Okay, so the rule of 72, a lot of mathematicians and also bankers, they know about it. You take the number 72 and you divide it by your interest, and it will tell you the amount of years that it will take for your numbers to double. So for example, if you're getting 1% interest, it takes 72, you divide it by 1, it will take 72 years for your money to double.
Okay.
But then if you're getting 2% interest, that will take 36 years for it to grow.
Okay.
But then if you're getting 4% interest, your money will actually grow every 18 years. So people need to start understanding the amount of years that it would take for the numbers to double. If it would take you 2 years, 10 years, 20 years, 30 years, you need to know that. So then that way you could understand the amount of work that comes for your money to grow for you.
Got it. So you take the interest they give to you,
Correct.
divide 75 by the interest.
No, 72.
72. Okay, the rule 72.
You take 72, you
All right,
divide it by the
72
interest.
divided by the interest. So let's say you get 5%.
So,
It's gonna be 14 years.
yes.
Let me play with this. If you get 7%,
Okay.
it's gonna
72.
be 10.2 years.
Correct.
10
correct.
years.
Correct.
If you get 8%, it's gonna be 9 years.
Correct.
So that means that's beautiful. If you get if you get 12%,
Yes.
it's gonna be 6 years.
Yes.
So I believe this is what happens in the Bible when the master went away and he gave talents to his servants, and they doubled their talents in the same period of time. It seems like they knew the rule of 72.
That's
Because
a good one.
the first one had 10 and it had 5 and he made it become 10.
Correct.
The other one had 2 and made it become 4 in the same period of time. So I just want to say that. I
That's a
don't
good
know.
one.
Yeah.
Yeah.
All right. So that's good. So what else would you like to teach the people today?
Another factor, let's go back to retirement again.
Okay.
So let's say, for example, if I need to receive $40,000 a year, I need to make sure that for my retirement, I have at least $1 million. It's called the rule of the 4%.
Okay.
So that means if I have $1 million in my retirement, then I'm able to withdraw 4% out of it. But then in the same time, if I have to pay taxes on that $40,000, that's not going to be sufficient.
Yeah.
That's one. But then second, if I'm withdrawing the money within it, then that means that there's going to come a time where I'm not going to have money within the policy anymore because I'm subtracting, but then I'm not adding any more money.
Yeah.
But then versus if it's like, for example, I have clients, they're like, okay, Rose, I'm losing so much money right now because of what's going on within the market. It was my dream to retire at 65, but hey, this year I already lost like $80,000. So a person like that, I sit down with them and I show them how to actually roll over the money into an annuity. Once they roll it into a fixed index annuity, they actually getting compounding interest. They actually starts out with a bonus. So let's say, for example, I had 100,000. I roll it over into my annuity, into my fixed index annuity. When I roll it into my fixed index annuity, the company is going to give me 30% bonus. So now rather than me starting with 100,000, I'm actually starting now with 130,000.
Okay.
But then with my company, they're actually giving my clients 8% compounding growth. 8% compounding growth out of with 130. By the time I look up 8 years down the line, my 130 will be 260. So that means that rather than me hoping that, okay, I can retire one day, if I sit down with my educators and actually get educated, I'm then able to make a decision to where I could strategically plan my retirement versus hoping that I get into retirement.
This is good. This is powerful. I mean, people need to pay for this. Yeah, I'm going to create a Patreon. Like they can only access this information people who pay, because that's a lot. That can save people millions of dollars, what we're talking about here. So, yeah. That's good. That's pretty good. So we talked about insurance, having the final expense term and IUL, Index Universal Life, how you can use the IUL to fund your dream, to build your own bank and things like that. And then you talked about trust, about retirement. Yes. So give me a summary of everything we just talked about.
Well, the number one thing is people need to start prioritizing self. Because once you start prioritizing yourself and you said, okay, I want to be there, or I want to do this, whatever you're then able to do, especially if it's your focus, you then could reach it. That's one. With me, it was, okay, Rose, you did not come from a rich family. So my goal is to create one.
Okay.
And by the grace, being in the United States, we're able to get access to so much information that a lot of people just not taking the time to understand that. But then there's so many things. They could do the protection. They could do the be your own bank, where rather than, taking money and gambling it or risking all of it, you could actually plant it into yourself first and then borrow against it. So that means that the risk of the money, you actually put it on the company, not on you. And then from there, still have access to the capital to go do whatever you want to do.
That's good. So one of the ways people plan their retirement is using the Index Universal Life.
Yes, because that'll give them access to the capital without having to pay taxes. But then in the same time, they don't even have to worry about putting that money back.
Do you know that some people, they're just working and hoping that at the end they have enough money to retire?
And that's sad, because if we don't plan for something, it's inevitable. It will happen. Getting sick, you could just literally go to the hospital and putoof, they say you have cancer. Or putoof, you end up having or getting into a fight, and then you end up having a stroke.
What is putoof?
Oh, putoof is basically like out of nowhere.
Okay.
Something just happened to you.
I was going to look it up.
No, I just made up that word.
Okay.
It's out of nowhere. It's in a switch of a light. You could just sneeze and then something could happen.
Okay.
So with us, it's not if something is going to happen. The matter of the question is, when is something going to happen?
Yeah.
Because we're living in a country where we're way more likely to get sick before we pass. So people need to start planning for the future, not just allowing the future to get to them.
Yeah, so that's pretty good. All right, so by watching this video, I believe that people will start to understand that they need to plan, right? That's the first thing. Get to the point to start thinking that it's necessary to plan your future. And it's not that you're preparing your death, but if you're preparing your death, that's okay, because everybody's going to die. at some point, right? So nobody's gonna get out of life alive. So, well,
No.
that's what it is. Yeah. So, Rose, thank you very much for coming to the show today. This was really insightful.
First and foremost, thank you so much for having me. Everybody's supposed to want to build wealth for their family.
Yeah.
So with us, sitting down with anybody, you don't have to be a millionaire. You don't have to be a billionaire. Anybody and everybody should want to protect their family. Because at the end of the day, that's all we have.
That's all we have.
That's literally all we have, each other.
That's good. That's
so
good.
Thank you for having me. Rose Apollon with Liberation of Self. My website is liberationofself.com. You could find me everywhere. I'm on TikTok, Instagram, Facebook, LinkedIn, under Liberation of Self. Once again, thank you so much for having me. And I'll see you guys at the top. Thank you, thank you, thank you.
Of course. All right, everybody. Thank you very much for taking the time to watch this video. This is It's Possible